Good morning, folks. You guys can give me a heads up on Twitter if you can hear me. Good morning, good morning, good morning. Can you hear me? Hello, testing. All right, there's the opening bell. Can you guys hear me? Hello? Yeah, I'm not sure why the volume's not higher, so leaving comments and telling me that the volume's low. I can't help you. Everything's set to its maximum settings here. All right, lower left-hand corner, 5-minute chart, we have a opening range gap, premium opening. Okay, sweeping Friday's high once more. You look on the, let's see, do a 15-minute time frame. 15-minute time frame. We have it in log at around the 850s. Got a bit of a migraine today, so my pace is going to be a little bit slower. Some of you will probably you'll probably appreciate that. Seasonal stuff. All right, so inside the opening range gap, which is presently shaded green, but I'm going to change that because it's not what I want to highlight. I want to keep the same colors I'm using when I teach Caleb. Not that I have this kind of stuff in my chart because it's extremely distracting, but I don't know how else I can draw attention to certain things unless I put lipstick all over this stuff. So all right, today's topic is, and as a reminder, I won't be live streaming tomorrow. So it's the Fed's rate announcement. It's something that I would have my son completely avoid trading because he's too inexperienced. So I won't be live streaming to keep that. As an enticement from him. You're welcome to obviously do that. I'm sure everybody else will be streaming. But today's topic is going to be what happens if you miss your entry. Say you're watching a particular time frame. You get a green light that it's good for you to take a trade, and just either you sit still, you freeze up, you second guess it, or you turn the charts on late, or you didn't notice it and then it's now after the fact. So how do you work with that? So we'll be dealing with that topic. If you look at the 5-minute chart here in the lower left hand corner, I like that sell side right here, and the September, I'm assuming that's the 16th, really, because, or no, it might be the right one. I don't trust the dates on these, so I'm trying not to call attention to the dates. I'm also testing it to see if they agree with the ones I have. But anyway, because we opened up with a premium gap, opening range gap higher than previous day's settlement, it's most likely, a 70% chance that in the first 10 I'm sorry, 30 minutes before 10 o'clock or by 10 o'clock, it trades to mid gap. So we're looking for this price down here. And it's also a pool liquidity resting on this little base of price action. So first presentation, fair value gap is here, right there. This is not where I want it. Hopefully, if all things are good this morning, I won't have a very long session, which is my intended goal. And let's take the midline off of that because I don't want to see it. There you go. And we're going to work primarily off of the 1 and 15-second chart today. Now I know some of you don't have it, or you don't have access to it because of your I guess your plan or whatever. You don't have that function or feature for TradingView. It's up to you to get it, but this is what I'm teaching my son to work with. So you can apply this to something like if you were looking at a 1-hour chart, if you're a little bit larger term trader in terms of the time frames, like you want to have a little bit higher time frame because you believe foolishly, but it's okay, I understand, but you think that these lower time frames are moving faster, and they're not. They're not moving any faster than any other time frame. But if you'd like to look for setups, like say on an hourly chart, think of it as my 1 minute is your hourly chart. Okay. And then you can use something like a 15-minute time frame or 5-minute chart to get into a move that you may have missed on the hourly. Or say you're panning through and you see something, oh wow, I didn't see that set up there. I wish I would have saw that, but it's now starting to move. Now we're trading into first presented fair value gap here. I really want to work inside of the 10 o'clock hour for silver bullet. Like I want to use that information during that hour, but I'll wait till 9:50, 10:10 macro. So I'm purposely sitting still. If the trade sets up, I'm going to let it go, and then I'm going to try to use the logic I'm trying to convey to Caleb and all of you willing to listen, is how to get into a move that's already happened to start or move, which in my opinion is a valuable skill set. No, Daniel, I'm not drinking from the Yeti. Sorry. All right, so here we have this candlestick's high. You're going to look at the value up here, upper right-hand corner chart. So the high value on this candlestick is, where are we at? 19,793.5. We have yet to trade to number 3 candle's high, which is 19,795 even. And this one, I think, is probably the same price as that. Yeah, same highs. So we have to trade to, technically, 794.75. We have not traded there yet. We have not traded there yet. That's using my model. That's how I would try to enter if I'm aggressively trying to get into a trade and I have a bias that would be bearish. All I'm doing is giving you a reminder that we're looking at mid gap down here. And let's do this. Change that there. So I'll check my So settlement, previous settlement, opening price. Here's your opening range. Gap, and then we'll grade it real quick. Drop in the fib one. So then we have our upper quadrant we've already traded to. That's this right here, and all the other time frames. And now go back to electronic trading hours. My advice to Caleb is that if he's going to trade the day before FOMC, he needs to do it in the morning session, which is fine because that's his model. He won't be trading the afternoons. I'd like to see this here jump up into that fair value gap there. The reason why I would encourage him to stay away from FOMC days is because he doesn't have the experience, and most of you probably don't have the experience if we're being honest, to not get excited about what you think you see in the charts, because that day is very manipulated, and even after the fact. Okay, like it's a two-stage delivery. 2 p.m. tomorrow, the market's going to go one direction. It's going to shoot either higher or lower. You don't know which one they're going to do first. I don't know which one they're going to do first. It's heavily manipulated. And then at 2:30 during the conference call, Powell's a little bit like me. He likes to talk a lot. So sometimes that 2:30 counter run. So whatever usually happens at 2 o'clock, 2:30 usually runs right over top of that and goes the other direction. That's usually, not all the time, but that's usually what happens. Kind of like a non-farm payroll event. It's the same thing, but it's a little bit more exaggerated. And if you're wrong, or if you're over leveraged, you're probably going to regret that. And I just want to include that in his early development stage, just to avoid the day entirely. That way he can't be enticed to do anything. He can't feel any kind of regret. So what I was looking for is a run, because we had this low and then this low here, trading down into the upper quadrant of the opening range gap. That means the difference between 9:30's opening price, the very first tick opening print, today's trading, and yesterday's settlement price, when the market technically settles at 4:15. Since there's no trading at 4:15, it's 4:14 is the last print. So that's what you're looking for in your lower time frames. So between those two times, that's what makes up the opening range gap. Opening range is a 30-minute time interval, so up to 10 o'clock, and that's here. So we still have some time there. You want to keep your expectations kind of light also the day before FOMC. It kind of goes without question that, would anyone really want to go out there knowing that there's going to be such a volatile delivery and price? Like it's going to go all over the place tomorrow. So if you believe in the adage of buying and selling pressure, who in their right mind would be trying to position ahead large positions? Why would they want to get into the marketplace ahead of something like tomorrow's FOMC rate announcement? Like why would you want to do that? Why would they incur unnecessary risk? They wouldn't. All right, so there's the first presented fair value gap, and I was explaining it off of the basis of this low falling short of the upper quadrant level of the opening range gap, and then it trades down to that, sweeps that low, but it trades to the upper quadrant level, and then we created this little tiny little fair value gap. You see that in the lower lower right hand corner chart. When we were trading, I said I want to see it trade up in that fair value gap. This is kind of like what I was hoping like Trades by Matt guy would try to trade like that. because what he's aiming for, that's basically it. That's his whole day. It's just something like that, and boom. I mean, it probably wouldn't be good for business for his live streams. He'd be in there now. Okay, guys, see you later, or let's just talk about whatever, which is cool. I mean, I love him. I think he's a nice guy. No drama. The Nasdaq Cowboy. I love his song. Like I listen to it sometimes. I'm driving. I turn it on, and it's like that's actually a catchy little jingle. But you'll see on a 15-second chart if you can find 1 minute, 5 minute buy sell liquidity, and you want to write this part down because, like I said, I'm going to be waiting until we get into either the deeper half of the 950 to 1010 macro before I look for anything, or after 10 o'clock. But we're going to wrap it up at 10:30 this morning, so that way it's a little bit shorter, and I want to kind of keep to that. I know I say that, but I have to force myself to do it because Caleb can't keep up with this while he's working his job. So, but if you in your notes you want to write down um, for fair value gap trading, you can do high frequency trading, and it's not complicated. It's extremely easy. You can do it without a bias, and the only thing you're doing is looking for relative equal highs on a 5 or 1 minute chart. Once you map them out in close proximity to where we're at right now. So what would that look like? Well, you would have, we're going to use the 1 minute chart. Okay, I'm going to maximize this for a moment. And yeah, I'm ruining it for you. There's a guy on Instagram that has a large. I don't know if the followers are bots or what, but he has my name like he's pretending to be me. I'm not on Instagram at all. I'd appreciate if you guys reported it. It's like a 200,000 follower account. That's not me. And he links my YouTube channel like I would if it was me. So I'm hoping that when people go there, they click on that link and they watch videos like this where I say I'm not on Instagram. 2024. There it is. And then we'll do it in black. It giddy up. Huh. It doesn't really work well, does it? So that's what I was saying about wanting to waiting for a little bit more time-based delivery. If you're expecting this just to go up there and fill like I would do if I was aggressive and it wasn't a day ahead of FOMC, getting in that entry price there, you would have to endure this. And when you know what you're doing and you understand the characteristics, you know what is going to happen. You know the likelihood that a fair value gap, a PD array, it might work through them. And that's not failure for the sake of the methodology. It just means that it's going to color outside the lines and get a little animated. And you can see that happening here. Sell side here. So that would be like a high frequency run to short term, either 5 or 1 minute buy side or sell side liquidity. Using no bias, just zero bias, just looking for a price run that takes out short-term highs, short-term lows, and you can do that all day long, and not even have a bias for the daily session. I'm sorry, for the daily candle, or the session you're trading being like the New York session, the morning session, or the afternoon session, or if you're trading in the lunch hour, you can use the same thing. Like, you don't have to be in here sitting still and only trading on a higher time frame bias. That's not required. But when you're first learning, it helps. It gives a framework. So now what I'm doing is I'm watching the this wick here, upper right hand corner chart. I'm looking at this wick right there. I'm looking at the 765 and a quarter level. Because we traded up into the first presented fair value gap there. I know some of you are probably short right now. This is the mid-gap level down here. Let's do this. So mid-gap's here and 10 o'clock here. So we'll see if we can get that mid-gap delivery by 10 o'clock. Messing it all up for you guys out there wanting to make copies of these things, put them on your YouTube channel, and I'll push a button to get them taken down. So you can think to yourself for a second, okay? There are mornings where you'll get in or you'll watch the price. There's the delivery to mid-gap, so 70% strike rate. True today. And now we have the lower quadrant level here at 694 and a half. So that'll be our next downside objective. These, for the folks that make these overlays, I don't want to call them an indicator because they're not really doing anything like except for reporting previous price points. They're not manipulating the data. All they're doing is plotting it. That's why I said indicator / overlay. Overlays are a more appropriate term for it, because if you're doing anything to manipulate the data at all, it's not something I would do. So I don't trade with indicators, but if you are making these, or if you're the author of this one, and I'll show you which one this is so you'll recognize it right away. This person here. You want these a little bit further away from price. It's too close. It's very distracting for me So I don't know if it's a bothersome thing for anyone else, but you need to have it away. I would prefer having it set up the same way um, this thing here, the ray. Whenever you put that on your chart, it's always going to, if you put the annotation to the middle and on the right, it'll always be on the right side of your chart, all the way to the furthest extreme. That's how it should be. It should always be like that. And then you'd have the luxury of moving the chart around with the price to bring it closer to the annotation. These, I don't know if you can do that in PineScript, but that's my opinion. That's how it should be. Okay, so we worked lower, got close to lower quadrant, left a small little gap here on the 15-second chart, and then now we're back in the high of that new week opening gap. I was tempted to go in here today completely naked on the charts and have nothing on here, but my head's pounding me today, so I would feel the impulse to just try to put more stuff on the chart myself, and I don't want to do it. So we have a couple more minutes before 10 o'clock. We have a short-term high here with a SIBI, sell-side imbalance, buy-side inefficiency. So far, keeping with the logic, we can let trades go. In other words, you can see them coming, you see them formed, set up, all that business. First presented fair value gap here, 933. So I made this mistake yesterday, and I talked about how one of the candlesticks I pointed to was incorrect time. And it's because I'm talking live over the chart, and I have so many things I want to talk while the 1 minute chart was booking price. So I'm constantly getting information from what price is doing, and I'm trying to annotate and talk and answer questions I know that's going to come up based on whatever I just said moments ago, and also keeping in line with what I present for that lecture. So it's fine that I made the mistake of calling it the initial fair value gap or first presented fair value gap, but it doesn't change anything. It's not like it would have caused a losing trade or something like that. But I did make the mistake, and I corrected myself in the stream. I had probably 900 comments on yesterday's stream. Not that you could leave comments on that stream, but on other posts on my YouTube channel, where they could leave a comment. They were saying it. Everybody likes to correct me. The first presented fair value gap here is obviously this candle here. That's candlestick number 2. So to get short, and I told you I wanted to see the move start, like I'm letting it go. I told you that this price here would have to trade to 794 point. You're watching this price up here, the high. To use my entry technique, it would have been shorting as it slammed into 19,794.75. You may elect to trade a sell limit order. That would be at that price, 795 or higher. You could try to get the consequent encouragement, but it might not go there. You can try to get the lower quadrant. That's probably a good price to reach for. Or if you're really, I guess, greedy, you can go in there and try to get to the upper portion of this gap. You can see we just created a mohawk. So you can anticipate when the market will color outside the PD arrays. You see these jokers out there. I'll say, look, you're seeing your PD arrays getting run through. That's part of what you're doing. You're watching how it interprets that. How does it deliver around it? Kind of like if you're looking for I'm running a little bit slower today. it's like a feint, okay? Like a boxer might act like he's going to throw a certain punch, and or a pitcher, they throw a certain kind of pitch that makes the batter think, okay, it's coming right there, and then it just drops down, okay, or it curves. That's basically what I'm saying. I will allow the market to throw a curveball, and my PD arrays will get colored outside the lines. The mohawk here, going above that fair value gap, ideally it stays inside of it. And many times when we don't have these environments, which is the day before FOMC, that means it can be a little bit more careless in terms of its precision. It can be a little bit muddier in the water. So you won't see really crisp delivery of price action. So if that's what is likely to occur, why would you want to use your lowest entry threshold? Watch and see how it trades up into the fair value gap and be more selective. And in my opinion, allow it to first run to the extreme of it, because it might want to do that. And then once it creates the mohawk, you can trade inside that wick that created that, and you'll get really good premium pricing, and then trade down to the mid gap, because that's always in the first 30 minutes. That's your bias. If you're going to ask me, what's the bias, ICT? Well, there it is. See how hard that can be for you? You have to go and pull up a fib and drop it over the opening price of today at 9:30, anchored to yesterday's settlement price on regular trading hours. And then the midpoint on the fib, that is your 70% bias for the first 30 minutes. Like, that is so mechanical. It's so easy. Like, how hard is that? It's not hard. But you're out here trying to figure out, what videos to watch, where do I start? This is the series you start with. This one. This is the one that puts people right in the charts, and here's the setups every single day. It's the same repeating logic. We gap open higher. Is it more than 40 handles? Okay, then you have a respectable opening gap. That means then you can do what? You can anticipate the market creating a 70% strike rate of returning back to the half gap. So why are you complicating it? I'm not complicating it. You pick the first fair value gap that forms at 9:31. That's the earliest in terms of time. Between 9:31 and 10 o'clock in the morning, the very first fair value gap that forms. And how do you use that first fair value gap? Okay, I can see that, but what do you do? Well, what did I just tell you about the opening range gap? Mid gap. If it's below the first fair value gap price, which is this candlestick here, doesn't that mean the bias for the first 30 minutes should be what? Bearish. Is it not delivering it? And you're trying to argue with me that what I'm teaching is complicated. It's absolutely not. You're just not listening to the long, drawn out things where I'm explaining why it's best to understand every facet to it. And you curse me and you cuss me out and talk all this nonsense in comment sections of my videos, or even on my social media or other people's social media, saying that the stuff doesn't work. Well, find this stuff in anybody else's stuff. Find the first presented fair value gap. Find the fact that it's going to go to mid gap 70% of the time. In the first 30 minutes, you have an entire trading model right there, and you're done. In 30 minutes, you're done. I mean, I don't know. What else would you want? I don't know. I mean, I know I would want more, because I'm that type of guy, but you don't need more than to quit your job. I mean, you can do this over time and make more than your paycheck gives you. It completely strips away the ambiguity of where's the bias? What trade direction do I trade in? And now contrast that with people that will tell you what you're learning isn't real, or there's no real logic to it. I'm going to take this little box off now, because it's actually not that. I want to leave that up. I like to keep these dudes from looking smart by having my stuff up, pretend it's them. Let's maximize that 1 minute chart. So your stop would be above this candlestick here. So anything you're shorting in here, your stop's above this candle. So yeah, we wicked above the fair value gap, but that doesn't do anything to upset the trade. So if you know that it's going to be a day that has characteristics that allows and affords the market to be a little bit more muddier, where it colors outside the lines. How do we know that? How can we anticipate that? Because tomorrow's FOMC and the morning or day before can tend to be a little bit more reckless and more wild. The price can be a little bit more um, disorganized, basically. And shorting in this first fair value gap, the gap itself formed at 9:33 a.m. Candle number 2 is where your stop is going to go, whether you're going long or short. So think like an algorithm, okay? An algorithm is just a recipe. So here's the recipe. This is your blue ribbon recipe from ICT, where all you have to do is follow this logic every single day. You're not going to get a winning trade every single day, but I promise you, if you study it, go back and back test it, you're going to see an enormous advantage in how you could have been making a whole lot more consistent moves, passing your funded accounts, getting funded, getting withdrawals, getting all that stuff, getting real money, turning your demo account that you're trading with these funded account companies into money making machines. The recipe or algorithm is this: every day at 9 o'clock Eastern Standard Time, you're sitting down and you're opening up the NASDAQ, or you're going to open up the ES. It's the same thing. You're not making anything different here. It's just the same process. If you want to trade the Dow, I don't know why you would want to trade the Dirty 30. I can't stand it. It's too spotty. I don't like it. But if that's your cup of tea, just know that you're probably going to have a little bit more adversity in that one, because it does a whole lot of, it creates a lot more wicks. And it usually will move faster or before the other indices because it's more responsive, because there's only 30 issues in it that make up that index, whereas the S&P has 500 companies and the NASDAQ has 100. So because of that, that's why the S&P is a little bit smoother, because it's factoring a composite of 500 individual companies' price fluctuations and changes, versus the NASDAQ, which is a composite index of 100 stocks. And then you have the least, which is the Dow, which is only 30 stocks. So out of those 30 stocks, it can be influenced greatly by the price movement of larger stocks in that list of 30. So it's a little bit skewed, and that's why I don't like it. So that answers a lot of questions about the Dow and why I don't trade it. Can I trade it? Yes. Does my stuff work in it? Yes. But I'm not trading it. So I will use the Dow for a SMT divergence, early warning, but it's not the deciding factor. I'd prefer to see an SMT divergence between ES and NASDAQ. So if I'm bearish, I want to see like since I'm actively trading the NASDAQ, I would look at the E-mini S&P by comparison, and we are in the December contract. We're not looking at the September contract anymore. Do you see the S&T divergence? Don't worry about price. I got another entry. Don't worry. I'm purposely letting things move around. These highs here. This high went higher than that one, didn't it? Now look at it here with the NASDAQ. See it? Now, by comparison, this looks a whole lot more animated, doesn't it? And when there's wicks, I'm looking at the bodies, because that's where the bulk of the volume is. So there'll be times where you'll see that the wicks might be higher, but the bodies aren't. Inside this swing, compare that to here. So NASDAQ went higher, both in wicks comparatively between this highs and here. And in ES, I keep wanting to reach for the U for September delivery contract month. You see what's happened here? Y'all thought you knew SMT? You don't know SMT. Here's the high. And the wick went higher, but what do wicks do? What did I teach you? They do the damage. So this is an SMT divergence, because the bodies in the high here are lower than this. So that's why you got to stop listening to these dollar menu mentorships, because they don't know everything that I know, and they don't know the full concepts. Like I said, I've only introduced everything. Yeah, every single thing. It's just an introduction. It gives you a platform as a foundation to start understanding it. And you don't need to know everything and do well. But what happens when you really understand it? Yeah. So by comparison again, you want to do this in your own charts, by the way. Don't use mine. You want to use the time frame right above the executable time frame and the time frame that you intend to trade on. Meaning, as I mentioned at the beginning of the stream, I said that we're going to be working with a move that's already happened or started. Let's put it that way. And then what happens if you miss that move? Well, you have two choices. You can be regretful and get angry and get emotional and say, oh man, and then either chase it, or the worst is, okay, since I missed it, I'm angry. Now I'm going to fade it. I'm going to wait for it to, I think it ends now. So now I'm going to trade it the other direction because you want to wrestle the marketplace. You're mad at it. Never good. Now I like the 19,009 26 level. That's the equivalent of the September contract, and you can check that out. Look at your hourly chart on the NQU 2024 on TradingView, and then look at the August 27th through 29th highs. There are like 4 or 5 of them up there, real smooth. The equivalent for the December contract, which is what we're watching price in right now, that is the same thing here, right? So that's where those relative equal highs are. That's that big pocket of buy side liquidity. If we don't go there today, I think that FOMC tomorrow will target that area. So that's just a very loose expectation. It's not a hard and fast, it's going to do it. I'm not betting the farm on it. I'm not trying to position myself ahead. I'm not in any trades right now. I didn't trade last night. I didn't do anything. I just hung out and made a little video presenting gray pools, which is a PD array that I'll talk more about in the book, but it's how you use wicks. Okay, and wicks are a PD array that you can look inside of them in that little gray area of what nobody would really pay that much attention to, a cluster of wicks. But the algorithm, because it knows every single high and low, and it knows how to refer back to it based on its script, it's going to refer to those wicks in a manner that I outlined, and you can see it. So I'm not looking at supply and demand zones. I'm not looking at old highs and old lows for support and resistance. I'm looking at very specific prices. But where those prices reside in the matrix of where price is at the market, and if it's going to go lower, I'm going to be looking for discount arrays. I'm not just looking for inefficiencies like a fair value gap. I'm not looking for relative equal lows or a single low. I'm looking for clustering of wicks, because nobody's paying attention to them. No one's making any effort to see what was the purpose of that flurry of price action, redelivering multiple times in that area where you have multiple wicks overlapping. Right. You think the algorithm, if you can just give me the stage for a second, assume for a moment, if you don't believe there is an algorithm that controls price and it delivers price and it's a price engine, if you don't believe that, pretend for a moment that you did. Wouldn't it be logical if there were a algorithm that even that little messy area of a clustering of wicks, all different lengths and such, wouldn't it still have to work with that information there, or otherwise ignore it? And what problems would it create if it was ignoring that? And why would it ignore that? What would set the precedence over something else in the marketplace that the algorithm will refer to versus something like that? But then when you start seeing it like I'm teaching in the future with this, you'll see that you have an x-ray view of price. You'll be able to see things that are not technically in your chart. They're not in your chart. Nobody's seeing these things because they're not looking for it. Number one, they have no knowledge of it. They have no reason. There was no inspiration. Now there's going to be all kinds of people creating these bullshit storylines. Okay, that, oh, this is the thing, I've cracked Enigma. You don't have any idea what you're talking about. But I'm introducing it kind of like a little bit of a enticement to say there's new stuff coming. There's new stuff coming, and it's extremely precise, very, very precise, and it's time based. It's very specific time based things. I don't need to be in here worrying about every single fluctuation. I can set a date, just like when you set a birthday party for your child, or you set a date that you're going to be at a restaurant with your significant other at dinner. Here it is. That's the time we're going to be there eating. That's what I can do with my trading. And that's what you can do with your trading. And that is a liberating feeling. Contrast that with everything else. You're waiting for something to appear in a chart. Or you're just waiting. You're just waiting. Yeah. Well, keep waiting. So the idea of moving from 1 minute buy side and sell side and then using a 15-second chart, you can find very, very high frequency trading setups in that. You're going to get stopped out more times than anything else I've taught because you're going to be chasing every potential run into liquidity on a very small time frame. And the times you're going to get caught offside is when you don't refer to the time of day, the day of week, the week of the month, the seasonal tendency, where the higher time frame daily order flow and weekly order flow is reaching for. Specifically this. I believe this is where we're going to aim. Now, because that is a likelihood, and we have big news coming out tomorrow, I would not want to position very large today. I would not want to swing trade today. I think it's more reasonable to see them leave this here. It's just a real easy candy store to rob and just go in there tomorrow and smash it. They can be chopping around and do all kinds of, you know, subtle ranging, creating consolidations that many of you would be frustrated by. But when you understand that these are the conditions and characteristics, you won't be in here trying to trade larger or more frequent than you should. So while there is a approach to trading high frequency using sub 1 minute time frames, you can get 20, 30 trades a day easily. And that wouldn't be over trading using that model. Like, think about that. Like that in the hands of someone that doesn't know what they're doing and it's impulsive and they're over leveraging, you're going to blow your brains out because you have so many opportunities for you to mess it up, basically. I'm trying not to curse. So what happens if you know that this is the likely draw? If you filter out all the high frequency trading that you do sub 1 minute, aiming for short-term 1 minute or 5 minute buy side, using a 15-second fair value gap entry model, you're filtering out all the potential for you to get nailed if they do in fact want to run up there and hit that. So you see, it's not just give me the right fair value gap, give me a PD array, give me a straightforward model. I just gave it to you this morning. You're looking for a gap of 40 handles or more. Okay, the larger above 40 handles, the better. What was the opening range this morning? Previous settlement price at 661, 795. Hello, that's over 100 handles. So you are in a jackpot. Like, you have an easy 70% chance. That's not a 100% chance, folks. That's not a guarantee. It's a 70% chance that in the first 30 minutes, you have an ability to sit down, know exactly what you're expecting to see in price. What is that? You're expecting the price from this opening price here at 930 to gravitate down to half of the gap. You don't need the whole gap to close. There are things that you can trade with that gives that idea. I'll teach a little bit about that. But why worry about having that when you got something that's statistically probable over 70% of the time? I mean, think about it. You don't even get it right in your demo account, that many times in a month, a year. You have very, very low strike rate. And the people that are honest, they come out forward, they'll say, I'm about 50% accurate. And to me, that's offensive because I'm a numbers guy. I like looking for advantages. I don't want to go out here and just do something that doesn't have a built-in advantage. Who would want to do that? People that believe that price is random. So they submit themselves to, okay, well, it's probably not going to be an easy day, but I'm going to go out here and do something. And if you're a live streamer, it's even worse because now you feel like you got to perform. And it's illuminating watching individuals go out there and they just phone it in. They just lob it in and say, okay, well, there it is. There it is, guys. I did my best. Well, I'm telling you how to make your best better. Opening range gap. Okay. They're never going to hide this from you. They're never going to change it. And it's not going to be something that falls out of favor. Okay. Gap opening higher, more than 40 handles. The larger the gap, the better. That means your range is more opportunity. So from the opening price, as soon as at 9:30 opens up, you know what that price is. Everybody else knows what that price is. Down to that gap's midpoint, which is 728.25. So you have essentially, what is that? 50-ish handles. Now think about this. What would 50 handles do per week? Not every day. Not every day. Just one trade per week. You say, I'm going to find one setup because I don't know what I'm doing. I want to get consistent. I want to build trust in myself and not be impulsive, but I still want to show progress. And if you're trying to get a funded account combine passed, if you can't stick to something like what I'm outlining here, no wonder you're failing. And you shouldn't be paying for them. Don't buy any more of them until you can build yourself discipline. If you're not smiling and if the gears aren't turning in your head right now, how this is so fucking easy and it's in front of you every single day. And I've told you this for weeks now, and it's not every single day, but it's happening enough. Even if you did it wrong on the days that it didn't deliver, 50 handles is 50 handles. That's $1,000 on one mini. $1,000. What's $1,000 do for you once a week? One trade, you're not even worrying about it. In 30 minutes. In 30 minutes. That's how long, okay, you have to sit and wait. I'm satisfying every millennial's fucking dream. Okay? This is a millennial's wet dream. Tell me what to do, what direction, what's the target, and how long do I have to sit still and wait for it? I've answered all of it. There's nobody else out there that's giving you something like that. There's no one else doing it like this, baby. It's ridiculous. I got all kinds of stuff like this. But this is easy. Large opening gap higher, wonderful. Find the mid gap. There it is. Find your opening price. That's your range. That's the profit potential, okay? So now what do? You wait. In 1 minute from the opening price, you can take your time. You got 60 seconds to say, okay, what's the math on this? Here's my opening price, and then the mid gap price is down here. Once you anchor your fib to the opening price, that's your price you're aiming for. That's your range between this price and that one. So you know your bias is what? You're going to try to go short. So now what do you wait for? You just go in and go short? No. You watch price. You wait for it to do what? Create the first presented fair value gap. This is the first fair value gap. This candle here at 933. So it meets the criteria. It can't be on the 930 candle. 931 is the easiest and first, not easiest, it's the first earliest candlestick that can create the fair value gap, candlestick number 2, that one that makes the imbalance. This is candlestick number 1. This is candlestick number 2. And here's candlestick number 3. So candlestick number 3, your entry is either one tick below if you're aggressive like me and you know what side of the market you're trying to get in, and you just don't want to miss the move because I trust this model. I could trust this. I could be selling short there, and any opportunity it's inside that gap here, I'm going to short. I will short right at that mohawk because the stop's up here above this candle's high. I know this is intrusive having that laying on top here, but I'm sorry, but people literally take my stuff and they try to put their own YouTube channel, and it's just real easy for me to push a button and the copyright is done and they lose their channel. And I'm not trying to be a jerk about it, but you don't have the right to put my content on your YouTube channels, and I don't give you permission to translate them either. So and you can hate me for it, I don't care. The number 2 candle, that's the in a balance where it's this number 1 candle's low and number 3's candle's high. Anywhere in here, go short, stop up here. So this little spike here, they can crack jokes all they want, but I just gave you something they can never deliver. And this is such a good model. It answers everything. When it starts to break down, you find a short-term low. Once it breaks that, you put your stop loss to cover costs. If you have more than one contract, you take a partial below the short-term low. Everything I'm saying here, when we have a gap lower opening, more than 40 handles, 50% of the gap is your target. Wait for the first presented fair value gap, and you're going to be using it as a means to go long and trade up to the half of the gap. Here, first fair value gap here is your entry mechanism to get down to mid gap. And you have a 70% strike rate built in. You've got a home field advantage that this is going to happen 70% of the time. Daily. Now, you can further increase that strike rate by understanding the economic calendar. Hello. And understanding the likelihood of what happens if you take 75 to 80% off of the trade at the mid gap and you don't have the experience and you want to see if you can go down to close the entire gap. Okay, just put your stop loss somewhere above the short-term low you took profit at, or partial. And if it stops you out on the bounce, who cares? At least you had a free look. You did 80% off here, remaining from the position after you've taken off a partial. Or don't do any partials. Just expect that it goes below this low and accelerates to mid gap. Look at the bodies. Look how the bodies are respecting that mid gap level. That's algorithmic. It's doing something that it's been scripted and coded to do. Just like a recipe. I want you to think about the potential that I just laid in your hands. I've already taught this a few times in my lectures. I've taught this, but you don't remember it because you're waiting for something where I'm drawing over top the chart and I'm trying to tell you what the market's going to do next. Why worry about what's happening next when I'm telling you how you're going to find what's going to happen next every day? What's more important to you? The fair value gap that I'm going to push a button on today, or having the logic where you don't need to come back to watch my channel? How's that working for an ad revenue campaign? I don't want you coming to watch my videos, because if you keep coming back and watching my videos, that means you don't know anything. You're still learning. And if you're brand new, that's reasonable. But when somebody finds a model like this, why would you want to worry about whatever else I put up? Why would you even want to buy my books? How's that for a sales campaign? I don't need your fucking money, okay? I'm just presenting it because it's my stuff and nobody else has the authority or the understanding to be able to do it. And I want to document it. My sons and daughter, they can hear me talk about it. It's not just looking at my notes, looking at my journals, looking at my things that may not be as a clear depiction or understanding of what it is that I'm actually teaching and what I've used. It's my whole entire life's work. And this is not in Al Brooks bullshit, okay? No offense to the guy, but I don't have any connection to any other mentor out there. And Larry Williams wouldn't even know anything about this either. Ask him. Don't be rude about it, but I guarantee you, he'll say, yeah, I don't know anything about that. He was my first mentor. Anything that's ever had an influence on me from him, I've always credited. And I told everybody, buy everything he has. And everybody should have that book, How I Made $1 Million Trading Commodities Last Year. It's a 1970s book, and there's a lot of stuff in there that doesn't hold water, in my opinion. But the very specific things in there about premium pricing, that means the front month is more expensive than the distant month. For instance, what would that mean in terms of trading the S&P or NASDAQ. Right now, the nearby contract is September still, and it's going to expire. And then it becomes the December contract entirely. So that's your nearby contract or front month. Then you have the next month out, which would be March 2025. And then the next month out would be June 2025. The next month out would be September 2025. In a carrying charge market where the normal pricing model is in play, you will have higher prices for, like, if we're looking at corn or soybeans. Usually it's more expensive. The price right now for this contract in December is trading at $19,797. Now contrast that with NQ for the September contract. We're in the 500s. So there's a premium in the December contract versus the price that's in September. You see that? Well, that's a normal carrying charge market, and it's more useful in a real supply and demand market like grains, cattle, something that we eat or consume, oil. Okay, there's a real buying and selling demand in these markets because they're like they're the resources that makes the world go around. We don't really need to buy the S&P and the NASDAQ, just like we don't need to buy shares of stock. So while it's better for the market, if you're bullish, to see the nearby contract trading for more money than the next month's out in the future. In other words, the price should go higher in the future when you're looking at commodity prices. But if that ever reverses and it's higher prices right now, then you have an inversion from a carrying charge market to a commercial bull market. That means large conglomerates and commercial users are more interested in buying it so much it can maintain a huge premium in price relative to the traded price of the distant month contracts. And if you're brand new, that probably went right over your head, but it's a very simple thing. If you go into the commodity teachings that I have in the 2027 mentorship, I believe it's month 10. I believe it's month 10. I split up that month with bond trading, commodity trading, stock trading, and for the life of me, I can't remember what the other one is. I don't remember, but it's in there. I talk about it. But I'm not even sure how I got on this subject matter, but you have a model now. You have no excuse not to be finding consistent setups every single day. You have an experiment laboratory for 30 minutes every single day. Caveat now. Here's the spin on that logic. As long as price remains below your stop loss when you're short using this model, and we have not traded to the mid gap, you stay with the trade until you're either stopped out or you get your target. Is that complicated? Nope. Now, how could you mess this up? Okay, here's how you're gonna mess it up. You're going to over leverage. You're going to try to trade before the fair value gap is traded to. You will not take the trade because you haven't watched it enough times for weeks and months to desensitize yourself to it, to trust the data. Don't just take my word for it. I don't want anybody taking my word for anything that I say. The open challenge is go in and see if this stuff isn't really going on. Because once you see it, you can't unsee it. No one's going to convince you otherwise, and then you're a cult member for life. Okay, and that's not a bad thing. It just means that you're part of the cult of winning. There's no other simpler system model that's mechanical. It's finite parameters. Just like when you read a recipe. How many eggs does it call for? How much milk? How much sugar? How much flour? You can't go in there and say, you know what? This pineapple upside down pineapple cake calls for this, 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 and this. I just want to kick it up a notch and put my own spin on this. And I'm going to throw in horseradish. The hell? Yeah, that's what you're going to mess it up with. You're going to try to bring something else into it. Okay, you're going to come up with some bullshit name for something and try to reinvent it so that we can go out and here it is. But in my book, I'm going to reference these videos where it's time and date stamped, where you can see me giving the details about this. I promise you, what I just taught is there's going to be dozens and dozens of books before the fucking November holiday. Amazon's going to have ICTs, elite day trading model, 100% mechanical, and they're going to inflate the number. 100% strike rate, guaranteed to make money. Yeah, and it's going to be, that's fake, that's false. But 70% of the time, you're going to see that these parameters deliver. But it still affords the ability for people to mess it up because they're going to bring their own problems to it. They're going to be fearful. They're going to be too impatient. They're going to try to trade before they should. They're going to over leverage. Or they're not going to be disciplined. They won't be in front of the charts to do it. They'll live a lifestyle that allows them to get drunk, inebriated, and sleep over and miss it. And then because they didn't take a trade the previous day that was really, really good, then they'll over leverage on the next day thinking, I got to make up. No, you don't make up anything. You just take the trade based on the parameters. And that means trade with one contract, the smallest contract, the micro. And you desensitize yourself to the importance of the money. Take that part out of it for weeks up to, give me at least 1 month where you're doing this every single day. So that way you have a whole month of data. And then see what you were recording about what you felt when you were doing it, watching it, observing it. Did you get emotional about how you were feeling you're going to be right and conquering? Were you fearful that it wasn't going to work? You have to get that baseline measurement about you, because the you is what's going to mess it up, okay? Trust me, the first time I sat down and I put this to task, I was like, I want to have something that's mechanical, that I want to know that this is what I can do, and I will set up a scenario where I can automate it. And this is one of my first automated things with TradingView. I'm not TradingView, TradeStation. Uh, I did a lot of coding with easy language with TradeStation back in the 90s. And this was one of my simplest, easy, bread and butter. Just, it's like a cash machine. It just simply will spit out the setups to you. And it's like an ATM with a PIN code that you know has an endless supply of opportunity. It's just right there all the time. But I don't want you to believe that. I want you to go in and test it for yourself. Because as soon as you see it, it's going to be like, what the hell? You've been trying to do all this other stuff. And the whole time, every single trading day, if these parameters are there, 40 handles or higher, there has to be 40 handles from previous settlement price to where we open first or more. It's better if it's larger. It's really, really good if it's larger than that. If it's over 200 handles, I've seen in the last 2 years or so, I will defer trading this setup because chances are it might still keep running because something else, there's heavy manipulation going on. So 100 handles, let's make it a little bit clearer. 100 handles approximately, minimum 40 handles. That's your sweet spot, okay? And if you use this mechanism, okay, there's a lot of you guys that do coding and such. You have everything right there. I just gave you the documentation stage of it. All I got to do is go through the coding aspect, and it's an easy fix of just putting a couple things there, and then bang. You know where the stop goes. You know where your target is. You know what you're looking for. It's time-based for the first fair value gap to form. 1 minute chart. And then by 10 o'clock, it should deliver 70% of the time to mid part of the gap. Like, come on, man. Seriously. Like, who's giving you anything close to that? You know what time it's going to set up. You know how long to hold on to it. You know what to do if it doesn't trade to the target yet. You hold it or let it get stopped out. And be comfortable with it getting stopped out. Because you should have a partial taken. If you're trading with one contract, allow that stop out to happen. And then record what you felt as a result of that. You're going to go to, I wish I would have closed the trade at this point where it was the maximum open profit, but not realized. And if you do that, what you're saying is you want to be right. And you have to work on that. That's what you're supposed to be doing when you're tape reading. You're discovering yourself. And when you demo trade, you're trying to discover where your bad habits are. You're not thinking that. You want to have something to go online and show people, look how much money I made today. And nobody's impressed by that. Nobody's impressed by that. Because if you can't make that bread for real and eat on it, that means make real money with it, what difference does it make? Everybody out there can get lucky, but this isn't luck. This is logic. This is very, very specific rules. If it's doing this, then you can look for this. When this does appear, then you can take action on it. And where's your stop go? Above candlestick number 2 if you're short, and when you're bullish, it goes below candlestick number 2's low. How hard is that? It's not hard at all. And you take what the market gives you. Some days it's going to be amazing. The stop will be very small relative to the distance for where the first fair value gap forms, and your entry would be at to half the gap. So anyway, you can see, look at the characteristic of this market right now. I got a little carried away. It's just ranging, and that's classic the day before FOMC. So I'm going to strip this down to the 2-panel view. All right, and then I want that 15-second on the right side. And this is your 1-minute chart. I'll take this off here. All right, so see what they did here? We have these lows. This is jagged on the bottom end. What's up here? Short-term buy side. Isn't this fun? Isn't learning with good old ICT fun? Give it a thumbs up if you appreciate the fact that it just gave you something that's going to pay your bills for the rest of your life. You didn't have to pay for it either. No mentorships required. No book sales required. You don't have to spend any money. No money at all. And you got something that answers everything you'd ever need. And it doesn't need to concern you if it's going to stop working. They're going to change the algorithm. It's literally, it's something that's going to repeat in perpetuity. As long as there's markets, there's going to be an imbalance likely to happen in the morning session. It's always there. And that's how they use and entice initial market sentiment. That's the purpose of the gap. It's not the buying and selling pressure. So, all right, over here we have 15-second chart. It's a little spotty for 15 seconds, and it's because it's the day before FOMC. I would not be terribly excited about this afternoon. So I know some of you that are watching you live stream, try to avoid trading the afternoon. If you're going to trade it, just do it in your own privacy, because you could probably be met with a little bit more difficulty because you're getting closer to the time when absolutely nobody wants to do anything in the marketplace. All right, so hopefully you can get a little bit more displacement here on that candle and give us a fair value gap. Now this is, again, this is a drill. It's not meant for you to copy me. It's for you to get a baseline, see what, if it runs right to that, if it runs right to 1850, then we have to wait. It's got to give the gap on the 15-second. But you're doing these drills as many times as you can afford to do it with your schedule. If you can only do like 1 or 2 a day, that's fine. It's just like an exercise routine. You just go into lower time frames, find a relative equal high or low, and you're not demanding your right. Okay, saying that's what I don't want. I don't want to see that. I don't even have my buttons up. Crap. It's too close to the liquidity. I can wait. I don't have a job and I don't have anything to do today, so I can stay here as long as it takes. Just be comforted that we can see these liquidity pools and see how easy it is right to it. And that's just one instance where it'll do these, and that's it. That right there is something that you should log. It didn't give you the setup, like running into those I mentioned earlier. That's what I was aiming for. That's what I was aiming for. I wanted to get something in here where it traded back into a fair value gap and then catch that. So you guys would be like, what the hell? He did it again. But sometimes they'll run without it. And the fair value gap just doesn't, it's not given to you. And you can get mad about it. You can say, oh man, I missed that move. Or you can say to yourself and say, this stuff repeats. There's no need for me to worry about it. I'm going to find another setup. All I have to do is sit here and relax. So let me go back to this real quick. We had these lows here, and this was made jagged. So sell stops down here on the 1 minute chart were taken. Remember I was telling you earlier, if you're going to be doing these exercises, be aware you may not know how to do this because you're learning, but figure out where the higher time frame draw is, which was what I showed you earlier up here, that 926 level. And I mentioned beginning of stream these up here. These are all potential draws because of this being the higher time frame reason for markets to want to go up there. There's those relative equal highs that we were watching in the September contract, that is the same level here just for the December contract. So the prices are different, but the same school of thought or reason to expect to trade there is still the same here because it's still relative equal highs on the December contract. Is if you go back and look at the last week of August of 2024 in the December contract, it's a lot of gappy price action, but doesn't change the fact that it's too smooth, and we're most likely going to see it trade up in here. I'm not saying you need to do it today, but as a higher time frame draw, if you're going to be doing these little exercises to get yourself desensitized to getting into trades, get yourself some experience pushing the button, managing a stop loss, managing how you're going to endure getting it wrong if you're getting it stopped out, if it runs in your favor. It gives you all these perfect little laboratory conditions where you're not influenced by the money. You're doing one contract. You're not trying to pyramid. You're not trying to be perfect with your entry. You're just getting some kind of exposure in price action. Well, if we know that this is likely the draw here on the daily chart, then it's better for you to filter only going long if you're going to be using it to take trades with monetization at the end of it as a result. But don't think that way only while you're doing a baseline evaluation, because you want to see what it's like when you do it wrong. Or if you get into a trade and it runs aggressively the other way and doesn't go to your target. You need to identify how you're going to respond to that. You need to know that as soon as you can in your trading, because it's going to highlight what your character flaws are. And don't hide from it. It doesn't mean that you're a bad person. It doesn't mean that you're a bad trader or that you can't become better with these features and functions that every human being has them. Sometimes some people have really toxic, self-defeating things about themselves, and they don't see it that way. They like to sugarcoat it and pretend and put makeup on them and wear a mask and say, I don't have problems, it's everybody else. Your mentor talking to you, I have a lot of things that I wrestle with, and you as well. And they're going to materialize in your trading. Right now, we're looking at how prices respecting that September 1st new week opening gap. There's an overlap of here. This low is a new week opening gap low. I'm watching the bodies here on the 1 minute chart. So we don't have any buy side to refer to here on the 1 minute chart. So we got to go up one time frame. Yep. There's those relative equal highs on the 60-minute chart for December delivery, the contract. All right, so we have this high right here. You see that? Let me widen this out a little bit. For December contract, we have this high. moving still closer to the 19,926 level. So now that level, I'll change its style a little bit so that you can see it differently. All right, so there's another pool of liquidity, buy side, and it's framed on the hourly chart. And all we're doing is providing a means of framing an exercise. That's all it is. It's not a I got to be right. It's not a I'm Mr. Precise. It's not about you making money. Do not monetize it. Don't take a trade on it. If I'm given something here to execute on. Now, I would like to see this stay open because we already dropped into it here. And it didn't stay open there. But I would have seen it stay open if it started to displace higher. Then that could have created a fair value gap. That's what I mean by that. So new week opening gap on September 1st, just about near its high there. All I just did was annotate the minor buy side and sell side. How do I know that there's buy side? Because the market turned here and went lower. We created a swing low here, and this candlestick right there, as soon as it closed, that validated this as a swing low. So anyone that's long, they could theoretically, and that's all we're doing theoretically, is assuming that there's going to be some measure of stops below there. And then the buy side would be here. Just missed it, sorry. That candlestick right there, when it hit that, that was the entry for buy side. And then I would want to see inversion in here. we have this big block of back and forth price action where it spent time, a lot of time back and forth in this range. So 19.813.50 is also September's 13th daily high. So I'm not impressed with the run below the short-term low just to get to that level. It's not like I don't see it like it's breaking down to keep going lower. It's going to have to prove something significant to me. On the downside, I'm more inclined to fish on the upside, and it can drop, and it's fine. It won't be something that I would be regretful over, because you have to have rules, and the rules here, I'm not trying to be short. We've already shown a willingness to gravitate towards that 19.862.75 level, and that's not even close to the relative equal highs at the 926 level. Breaker, low, high, lower, low, this candle's range, and we have that little inefficiency there. That's where we're in. We're inside of that right now, so I'm watching it. So we're inside of September 13th old daily high. And while I'm talking on your own charts, you should drop a line on that September 13th daily high, and you'll see what that level is. But here's a breaker. So it would look like this. So I'm not inside that range right there. Ugh, it's too dark. Now, if we lose this range to the downside, then we may have done enough for the morning session going into the lunch macro, where they'll move against the traders that have been long. That would be this sell side resting right here on the left-hand side chart. But it has to leave this blue shaded area. If the breaker wasn't there, this would be the short. Now buy side goes to here. There you go. And new week opening gap. If it's going to go below here, it's reasonable to see it, try to reach into that as well. What time is it? 1050, 1110 macro. Sell side. That little gap right there, that's the one. But I wanted to see it come down and give me one tiny little gap below that. That was the one I was wanting the aim on, but I gave you this before it happened, so it's a consolation prize. It's called that. I know some of you are still hammering on whatever I'm saying. If you took that, don't tell me. People are still not listening and they're telling me in the comment section. This is what I took a trade here. I made this. I passed my combine. All right, so day low here. I'm not convinced that we're going to come down that far, but I'm willing to give it another opportunity to sweep below here once more. So this low now becomes sell side. So any little rally in here, as long as I don't go to the mean threshold of the breaker, that's this range here on the 1 minute chart. Then it could be just setting up a retracement here, just to dive one more time and get into new week opening gap low. Then if I can get a rally after that, I'll work with any fair value gap there to trade back up to the breaker if it can afford me 20 handles range. That's the filter. It's got to give me at least 20 handles of where I try to get in at and where I'm trying to aim for. If I can't frame that, then I have to sit still. And it can, I mean, we can see the moves coming, but it's not frameable based on the logic I'm performing for Caleb, which is 20 handles run from entry. Now, because we're below this breaker, low, low, high, lower low, then rallied to new week opening gaps, broke down, went below the breaker here. So as long as we're below half of this range, I wouldn't be interested in anything long. So what I'm saying is I'm looking for some reason for the market to fail to get above the midpoint. It can trade where it's at here. That's normal. It can trade right up to it. But the gaps, the PD arrays, everything that I have that I key off of in price, they all have an inverted aspect to them. So they can be treated the opposite. So what you think about classic support resistance, I can apply that to these things here, but it's not classic support resistance. It's very specific candles, it's very specific prices. The low, the lower quadrant, and the halfway, or mean threshold, because it's an order block. So half of this breaker to its low, that's like the area where the turn could happen, and a run below this low down the end log. That would be a setup. We have a gap here. If it runs away again, then it's just making my day longer. I want to put a short on so that way you can see trading against a higher time frame likely bias on a day prior to FOMC, late in the morning session. I see it wanting to take this short-term high here first. See how much time it's staying inside that gap? All here. You don't want to see that. And that would have been stop out. So I can see where I'd be wrong. And as much as it would probably be entertaining for some of you if I would have took that entry, I just know that it's not there. It's not there yet. But using that one, you would have been stopped out, or I would have been stopped out there. How did I know that? It's because I think that this was too easy, too shallow. And I think that either they're going to send it higher or they're going to take it right above this high anyway before it goes below these relative equal lows. So we're in between that little, I can justify both sides. And if I can do that, it's not high probability. So it's giving me the ability to show you, Caleb, that just because it looks like it's a fair value gap, where we're at, what time we're at, and how it just delivered that little tiny wick into the lower half of that breaker I was annotating. I feel like we've pushed it up a little bit from 930's high. We went lower. We consolidated, made all of this in here jagged, and once more here after trading into the new week opening gaps above the initial high of the day. Because we've had 1, 2, 3, 4 lows produced to the downside, this is really, really jagged. And I would be trying to sell short in the very low end of the range. So what would I be doing? Selling here. I'm selling a discount. There's people out there who want to buy something cheap. So I'm watching this high here because that'll tell me what I want to do. I told you I'm not leaving until I get something that I can frame on. And look at this. It's just slowly gyrating up to that little high right there. So anyone that's trying to be short or that is short, not that they're all using a 15-second chart, mind you, but you can see that high is also on the 1 minute chart. So you have to sit still sometimes. And if you don't know what you're looking for, it could be frustrating and just drive you nuts. But there has to be some reason why you're taking the trade. You can't just simply push the button to find out. I'm not here for that. I'm here to teach my son patience, teach him look at things with rules, frame the probabilities, and justify why I will or why I won't. All right, so now we have somewhat of a balanced price range in here. I mean, it's on the 15-second chart. I don't want to make too much of that, but this little gap here, we're seeing these little tiny candlesticks reaching up. I would like to see it just go above this high here and then come back down into this inefficiency and see if it can support it with inversion characteristics. Take this midline off. Just bumped the low of that breaker block. I don't want to see it hit the bottom of the breaker block and come down in here. I want to see it take this high, come down, hit that, and then if it shows displacement higher off of that, then to me it's a little bit more trustworthy to the upside. And then I can entertain maybe a run into the high of the breaker or this inefficiency right there. Come on. Now take a screenshot of what we're looking at here. This is exactly where you can identify where you do not want to trade. I'm going to force myself to trade in this environment because I want you to see the difficulties of it. I'm probably going to fail in it. That's why I'm telling you don't copy this one. But I want you to see before I do anything, look at how it's behaving. Is it animated to try to get anywhere in a quick, fast, sudden manner? No. It's just like, I'm just moving around a little bit lethargically. Either side of the marketplace, it should have dropped here if this was a valid fair value gap, which I told you because of all the things that are on the 1 minute chart, it doesn't bode well for selling short that cheap or low in the daily range after it's already had this big drop down. So this lunch macro where it took the sell side out over here, that right there might be the low, and we could be higher in the afternoon. That's what I wanted right there. Now, because this inefficiency is the only one that has any interest to me at all, I want to see, do they dive it back down into this? And then if it can hit this, but not go through it with a body, if it can hit it and displace higher, like a big, nice series of 1 or 2 candles to the upside, create an inefficiency there, then that could be a catalyst to get us up into that inefficiency there. I apologize, Caleb. I did not want the video to be this long. Shut up, ICT. You're here till you're 90. You're here till you'll be doing this till you're 90. That was a funny line in Deadpool. But I asked you to take a screenshot because the way prices just meandering around, okay, that is what happens when the market enters a buy model. It just sent, I'm sorry, buy program, where it just starts ticking higher. It doesn't matter how many people are selling short or buying. It's just going to keep offering higher prices, keep higher, and it starts squeezing and squeezing and squeezing. And then as it gets to a level where there is an inefficiency or liquidity, and on the 1 minute chart, you see it right here. That's that short-term high. These are very, very challenging conditions when it's behaving this way. If you're brand new, you can be smacked around a little bit or frustrated. So there's the wrong color, Michael. There's your buy side. All right, so now we're back above the mean threshold of that breaker over here. That's this candlestick right there. It's the last up close candle right before the drop down to a lower low there. So it's a low, high, lower low. It did not come down to hit this area here. It just kept booking price higher, 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 higher. So they're going to make a mad dash up to attack these buy stops. ICT's trolling today. Calling it live. We're doing it live. All right, let's see. Push this to the back. So we're back at September 13th's daily high. Top of the breaker. Now, because we have this area of inefficiency, now mind you, it's anchored on a 30-second chart, so bear that in mind. It's not like it's on an hourly chart where if this were an inefficiency in this time frame were a 1 hour chart or 60-minute chart, price would have no problem going up with one single candle into this little area. It can still do it on the 15-second chart. That's still a characteristic, but because it's only in a 15-second chart that it has this inefficiency there. Because if you look at it over here, it's been offered buy side delivery and then this single candle on the 1 minute chart. Inside that 1 minute chart's range, we have this small little inefficiency there. So keeping to the rules, I'd still would like to see it ram up in there pretty quick. And if it's going to get in there, why not just take out the liquidity right there? Working towards the low end of that breaker, spiking through mean threshold, which is the midpoint. Whenever there's an order block, half of that range is always mean threshold. If it's a gap or a wick, the midpoint is consequent encroachment. The books will explain why those names were given to it. I just don't want to talk about it publicly because it makes people stupid look smart. I said it incorrectly. It makes stupid people or fraudulent people look smart. There's no sense of helping them write their cliff note version of my concept just to get a book out there. You don't even make a lot of money on books. I mean, it's not even that big of a profitable venture. The only thing I'm concerned about is making sure I record it in the annals of history that this is what it is, this is who it came from, and now it's my gift to you. All right, so we're at mean threshold, half of the breaker. And we have the inefficiency right there. And I'd like to see that be used as inversion. So it would, you want to see it go away from a little bit and come back down into it. And then run up into that inefficiency right there. Now look at the delivery of price here on the 1 minute chart. Watch how when it goes higher. Do you see any gaps? This was immediate rebalance. Rally, 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 rally. Small little volume imbalance there. But no fair value gap. See that? And then delivered to the high of the breaker. This is a classic. This is why I tell you, take a screenshot of that. Because when you start seeing price doing this, that is the algorithm in a buy program. That means it's simply going to keep offering higher prices. It does not matter what your little book map things say. It doesn't matter what your liquidity things say. It means it's just going to start marching higher and higher, 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 higher. That was the reason why I stopped. I was going to take the short in here just to illustrate. This is shorting. And I was like, you know what? Why do that? It's better for me to illustrate why that's not even a good one. So the screenshot of you seeing how price is not giving you any kind of fair value gap. It's just one steady, just booking higher, booking higher, booking higher, booking higher, and no inefficiency. So if you're offside in that, it's very, very painful, extremely painful. Notice the bodies, we never left it and came back down. The bodies are staying inside of it. So is that displacement to the offside? No. You thought you had me, didn't you, Phil? Yeah, yeah, yeah. All right. If you weren't here today, what would you be doing wasting your time? You're learning how to read and navigate price action, navigating it, understanding why it should or shouldn't. Everything I can't do in a book. Imagine these as chapters in a book. It's very hard to write that kind of stuff and make it make sense. You have to see it. That's why I hate to say it, but 99.999% of any trading books are useless because a static picture and a couple paragraphs or whatnot doesn't adequately describe what it's communicating. I'm sure the authors are well intended. I would have intentions because I don't mind spending time bloviating in great detail about what I expect to see in price. I want to see this small little portion stay open. And now because we had this nice little retracement up in here, I'll explore to the downside. I want to see if we can get to the mean threshold, consequent encroachment of this gap. No, stay inside there. All right, wait, I'll wait for it again. I believe it's going below this low, so that way we understand what I'm expecting. We had this nice deep retracement. It pressed higher, 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 higher to the top of the breaker. We couldn't find inversion there. All the body stayed inside of it. Nice displacement to the downside. We rallied back up. I want to see this small little segment of price action here stay open, meaning that I don't want to see it trade back to the bottom of that blue box or into that volume imbalance. I'd like to see that stuff stay there. And if we can find ourselves heavy in this area, that should allow for a run to get to the sell side. We still have to wait for the fair value gap that makes sense, and that isn't making sense yet. It's got to still work out the creases. So knowing how you can fail, knowing how you can lose money, identifying it, and saying, no, this isn't it. That's going to come with experience. It's not a matter of going out there and try to trade everything and make money. The main thing is capital preservation. See, I don't like that. Ideally, it should have went to consequent encroachment of that gap right there. Why that one? Because it's matching basically this one. Single candle up, single candle down. They're sharing the same spatial range between their highs and lows that make this imbalances. So that's a balanced price range. So I want to see it trade down below it and show a willingness to hit half of that and then drop. Then that drop would be candlestick number 2 of a fair value gap that I could use to get in to get short and then run down here. But since it's not doing that, I have to sit still. Now we got the volume imbalance redelivered too. And now we're at, I mean, it could roll over here lower, but it needs to show a displacement sharply down to the downside. I want something at mid range of this gap down here. Even though this is a higher price, that if it's going to drop, this would be a better entry because it's a higher premium price. I don't trust that my entry there would be sound. Watch that wick right here. Now I don't want to see, if I want to try to frame a setup, which is what I'm trying to force myself into taking a short to this low. Yeah, I don't want to see it support price there. I like to see it lay down a candlestick, but not close outside the low of it and create a inefficiency so I can position inside of that. Volume imbalance delivered to that. Now this right here, just deliver it, man. There you go. Now don't run away. Don't run away. Don't run away. Don't run away yet. I want to see if we can touch the bottom of that inversion fair value gap. Not yet. Come on. Volume imbalance right there and the low. Oh, you fucking kidding me? Okay, well, we're gonna have to pretend. Okay, the stop loss would have to be above this candlestick's consequent encroachment of the wick. That's where my stop would be. So that way you can see where it would be at. Told you I teach with a demo. So some of you. Okay, so it would be one tick above that, and the limit order would be at that price. Okay, 745 and a quarter. It's this fair value gap there. Trading view. Come on now. This is the gap. Right there. That's how I was eyeballing. There you go. take a partial there. Not as sexy as it is when you see the executions, but it's okay. I'll work with it with y'all. TradingView, you cannot do any maintenance during live streams to ICT, okay? It's not good for marketing for you. It's not good. So always see what time you plan on doing maintenance. Schedule it outside the times I'm going to be live streaming. So you would be in with the stop that covers the costs, and you'd be in one partial already. So has some relative equal lows there. That would be a partial. So now you'd have two partials booked. Stop would stay right where it's at. So it doesn't matter where it goes now. You stick with it and aim for this lower here. And you just relax and let whatever's going to happen, happen. Stop would roll to here. And you'd stop out on the bounce there. And you do all your markups to get all your information from where you were entering. What was the total drawdown? how much heat, in other words, the trade would have placed on you, and you take your partials, where I was queuing up audibly, you would take a partial, and then the partial here, and we rolled the stop down, because once we have a partial, a second one, and we're getting close to the low we're looking for, this low here and the rejection block is what I was looking at. And that's why I said to drop the stop, theoretically and hypothetically, to here. Because what we're doing is what I taught you in this mentorship, where if you don't know how to time or select the partials to get out of the trade with pieces of it and profit, by chasing down a recent high, just let the market take you out. It removes all the worry about which one should I do or how should I manage it. You got two partials. You let the market take you out. And it doesn't have to go down and take this low out. It's just the target. So it removes all of the I have to be right stuff that everybody thinks that I teach. I don't teach that you have to be right. Now, admittedly, I'm a little disappointed because I absolutely wanted to be in this to show you with one contract how the stop would have been managed. So it's kind of like it's not as good as it would have been if I would have been in it. So, but I know some of you are out there taking this, and as much as I don't want you doing it, I gave you guidance because I know you probably are doing more than one contract. So, not an easy session. I mean, it's not impossible. Obviously, you can see what we were looking for, and everything outlined is in the video. You'll be able to listen to it and see it, but framing it where it makes sense. It has to make sense. Just because price is moving around doesn't mean I have to be in there, doesn't mean you have to be in there. But finding a setup, getting in, and getting 20 handles, 20, 25 handles, something like that. That's a nice little bread and butter type setup. There's opportunities where you can go back through price action. The main takeaway today is identifying how price was delivering all this run up to the top of the breaker here. All of this is all one-sided. All of this in that 1 minute chart. That makes it hard to find an inefficiency in. You have to just let it go, and then it'll do this. It'll give up the ghost basically, and just boom, you'll see an energetic run. And then here, big energetic run. I wanted to see this stay open. Now, why would I want to see that? Because if this is the low I'm aiming for here, if this would have stayed open, this would have been a whole lot faster and quicker. It still very well may go down there, but it would have been a lot less of this kind of stuff. It just would have been, I fell out of bed and there it is, done. And I would have been less inclined to tell you where the stop would have been dropped down to here. That would have stayed at where it was initially. Once it covered costs, it would have stayed there. And then the run below this and into new week opening gap down here, which is still, something that could potentially pan out. So I did my best with working with what was given to us today, teaching how to wait for a setup, being very critical of the framework, the things that I would like to look for. You saw me try to go in, but it's not my fault that TradingView was doing maintenance on their paper trading thing. I have to teach in a paper trading account. I'm not a licensed trade advisor. None of these things should be inspiration for you to go in and trade with your real money. I can't control what you're going to do, but I am asking you, if you follow this and you made money, please don't tell me. I don't want to know about it. That's not what we're having here. We're not a signal service. I'm not a signal provider. I'm trying to teach you how to read price action live with logic that I teach on this YouTube channel. It's up to you to decide whether or not there's any value in this. I personally would love to have had this information presented to me, and especially if it's for free. And I'm trying to help my son have all the advantages and remove as much as I humanly possibly can, as both his dad and a mentor of the trading side of it, to help him remove the likelihood of him hurting himself and making his progress as easy as it can be done. But still, you're still going to put the effort behind it, and it's not going to happen real fast. Okay. So hopefully you got something from this. Admittedly, my obsessively compulsive side is a little flared up right now because I don't like the fact that it didn't let me get in it. But at least I was able to outline it for you. So hopefully that's enough consolation prize for what we've seen here today. If you learned something from this today, leave a comment in the community post after this stream closes. I usually go over to my community post on YouTube channel and I put the date up and I'll ask you, what did you learn with this live stream? And it's the date in today's live stream. If you learned anything, I'd like to know what helped you. Um, and if you didn't learn anything, I don't care to know that, because when I see that, I just simply I'll block you, because that comment is just waste of stuff. It's waste of time. You're wasting time writing it, and I'm wasting my time leaving you accessible to me. I'm not going to give you any of my time. It doesn't mean you can't watch my stuff. It just means that I won't ever see your comment again. Now on Twitter, everybody is open. Like you can tell me anything there. If you learned something, tell me what you learned there. It's more dynamic. If I see something I really like, or felt like I struck a nerve in a good sense, I might respond to you. But until I talk to you on Thursday, because tomorrow, again, Wednesday is FOMC, I have a guy that's saying he's going to live stream. So I want to kind of like sit in and watch whatever he's doing. I don't know. And I'll be sticking my head in to some of my students' live streams and watching them do their thing tomorrow. And I'll be back at it again on Thursday, Lord willing, right around 9:20ish, right before the opening bell. So until I talk to you then, be safe.